Hey, very good evening, everyone. Thanks for joining us for today's Corporate Connect webinar. This webinar is organized by SIAS and supported by SGX Group. And my name is Sunny. I'm from SIAS, and I'll be your host for today. Today, we welcome a very sort of a promising REIT that's listed in Singapore, which I last checked is up more than 20% year to date with a stable dividends of around 8% dividend yield. And that is the Elite UK REIT. We welcome them this evening, as well as our audience from our YouTube channel, as well as our partner broker, Tiger Brokers live platform. So Elite UK REIT is a UK-focused real estate investment trust listed on the Singapore Exchange, and they are managed by Elite UK REIT Management Private Limited. They are based in Singapore, and the REIT is sponsored by Elite Partners Holding Private Limited, the parent company of Elite Partner Group and Holy Group Private Limited, a leading real estate and construction group. So Elite REIT portfolio consists mainly of freehold properties located in town centers, near key amenities and transport links across the UK. It is also one of the largest provider of essential social infrastructure for the UK government, including the Department for Work and Pension. As of 30th June this year, the portfolio is valued at about £421 million. So we will kick off today's webinar with a market highlight segment by my good friend, Mr. James Hoy from Tiger Brokers, followed by the corporate presentation by Elite REIT. Thereafter, we'll dive into the Q&A segment to answer all your questions about Elite UK REIT. So before we dive deeper into the company, let me invite James to come on to share with us the market highlights that he has prepared for us. Over to you, James.
Thank you, Sunny. Let me share my slides first.
Sure.
1 second. Okay, I hope that everyone can see this well.
Yes.
Okay, just 1 second. Okay. Hi, good evening, everyone. I'm James, market strategist at Tiger Brokers Singapore. So tonight, as usual, I'll be sharing some insight on the Singapore market. Okay, just let me go through the disclaimer first. This presentation is provided to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of future performance. So some market insights. So here are some of the Singapore equity market highlights for the past 1 week. The most important news is MTI upgrades GDP growth forecast for 2025 to be around 4%. From 1 to 3% previously. Bear in mind that Singapore GDP grew by 4.4% in 2024. So around 4% GDP growth this year is quite impressive. And this table shows you the top performance and worst performance in terms of week to date, month to date, and year to date returns. Basically, the winners and losers are quite random. I don't really see a pattern here for the past 1 week. And again, STI remains one of the top performing stock indices globally so far this year. The year-to-date return is about 25%. And again, we are seeing a broad-based rally across all sectors this year. Out of the 24% return in the STI index this year, the financial sectors contributed 10 percentage points, while real estate, including REITs, contributed to about 3.3 percentage points itself. So this also shows you the average return over the past 25 years for STI index. So generally, December is a good month. The average return for December is 1.6%. And so if you are expecting to see some pullback, seasonality does not really suggest that. Okay, so this is one of the most important slides to me. So recently we have been seeing some pick up in the small mid-cap stock prices, but overall they are still far below the 2007 high itself. So as market breadth continues to widen across all sectors, small mid-cap stocks and including REITs as well should benefit. So here are some of the latest developments to support growth in the Singapore market. Again, I will not go through one by one. Some of the important ones include, firstly, SGX and Nasdaq will collaborate to establish a dual listing bridge for both exchanges. Secondly, in terms of EQDP program, so far 3.95 billion has been allocated. The remaining 1 billion will be allocated in second quarter next year. Okay, here are some of the older news I will not go through as well. So the most important one definitely it would be the $5 billion EQDP program. So far, the first tranche of 1.1 billion was awarded to three fund managers, including Fullerton, Awanda, and JP Morgan. So they promised to launch funds to target small mid-cap stocks. MAS also recently allocated 2.85 billion to the second batch of the asset managers, including BlackRock, Amova, Lion Global, AR Capital, Manulife, Eastspring Investment. So let's talk about interest rates. So again, a lot of Singapore stocks, especially REITs, are paying dividends. So it's quite important to understand the movement of interest rates. To put it simply, as long as interest rates are coming down, dividend-paying companies will remain attractive as long as they can maintain the same dividend yield, because investors are basically getting a relatively higher dividend yield compared to a risk-free asset such as government bond or fixed deposit itself. Basically, interest rate in Singapore are quite correlated to the Fed fund rates. So if the Federal Reserve cut rates, Singapore interest rates should also come down. Basically, the bearish curve suggests that if US vacancy continue to fall, the unemployment rate in US will also increase significantly. So to avoid that, the Federal Reserve may want to continue cutting rates. So the future markets is now suggesting that we will see one rate cut in December this year and another three rate cuts in 2026. And basically traders are also expecting one rate hike in July 2027. This actually suggested to you that investor will be in a low interest rate conducive environment until around mid 2027. So again, we want to keep things simple here. As long as interest rates remain low, that should be constructive for the stock market and constructive for Singapore REITs as well. So let's talk about REITs. Basically, lower interest rates are constructive for REITs. So this is a chart that I constructed last year. Basically, it just means that whenever the spread between the 10-year bond yield and the REIT dividend yield is wide enough, the REIT prices or the REIT's total return should outperform. So the logic here is that if the 10-year bond yield only gives investor low yield, then investor might as well just invest in REITs to earn a better dividend yield. So personally, I reckon maybe the magic number is 3%. Whenever the spread is about 3%, REITs may start to provide a higher return to investor. So the spread is now 3.56%. So even though REITs have gone up quite a lot in 2025, the spread still suggests to us that REITs remain quite attractive. And let's look at PB ratio. The REITs PB ratio is now trading at about 0.99 times, which is slightly below the 15-year average of 1.01 time. So if you have been investing in REITs since the beginning of the year, you will, and maybe you will enjoy some of the good REITs return. Basically, in the beginning of the year, the REITs are basically trading at 2 standard deviation below the 15-year mean, 15-year average, and they have basically completed the mean reversions, when they touch the 1-time PB ratio. So right now, investor are really betting that whether all of the risk investor here will turn more optimistic and push the valuation to maybe one standard deviation or two standard deviations above the 15 years average. Uh, yeah, which I think is still quite possible because overall the market sentiment is quite constructive at the moment. Okay, so here is just to show you if you miss just a few days in the market can significantly impact your return. So for example, the 10-year average yearly return for STI index is 5.9%. But if you miss the 10 best days each year over the past 10 years, your average yearly return will be drastically reduced to negative 11%. So this is why I always advocate staying invested in the market. Okay, here are some of the Tiger Brokers welcome rewards. If you want to find out more, please scan the barcode, the QR code here. And that's all for me. Thank you. Yeah, over to you, Sunny.
Right. Thank you, James, for that insightful sharing on the what the market is doing, as well as giving us a backdrop on how the interplay between the interest rates and REITs performance is likely going to be like, okay, going into the end of the year and next year as well. So now we will move over to the corporate presentation segment. So do allow me to invite the management team from Elite UK REIT, which is the CEO, Mr. Joshua Liao, and then we have the CIO, Mr. Jonathan Edmonds, and of course the CFO, Mr. Michael Tong. Okay, so I'd like to invite the management to present to us the corporate presentation for this evening.
Thanks, Sunny. Happy to take it up from here. Hi, everyone. Thanks. Good evening. Thank you for dialing in and sharing your evening with us. We're very happy here to share with you who Elite UK REIT and and some of the business updates that we had for most recent third quarter 2025. Now, I think before we start, if you were to flip open your Tiger Brokers app and you see the statistics on Elite UK REIT, you see that, as Sunny has pointed out, this year we have actually increased our share price by about 22% year to date, and currently we are at 36 pence. But and also our dividend yield is roughly at about 8.6%. So that's some of the headlines that you see with Elite UK REIT. Now we're here to share with you why that is so and how we can continue to grow into 2026. So who is Elite UK REIT and what sort of assets do we have? We're fairly unique for a number of reasons. First and foremost, we are a REIT entirely comprised of UK assets, but we're listed on the SGX in Singapore. The portfolio that we have is also counter-cyclical because these are assets that's leased to the UK government, primarily used as job centres. I'll explain what the job centres is in a little bit of time. But the leases that we have are signed with the UK government. This is at the sovereign level, and these represent about 99% of our income, our rental income. The leases that were signed are also triple net in nature, meaning that the tenant here pays for gardening, utilities, and operation expenditure of the assets. We also have a portfolio of 100% freehold, virtual freehold, and long leasehold assets. Together, we have 148 assets scattered all around Great Britain, from Scotland to England to Wales. So what are these assets used for? If I could talk a little bit about them. These majority of them are leased to the Department of Work and Pensions. That's one of the largest government departments in the UK. So what are job centres? So job centres, I think in Singapore context, they will resemble a little bit of community centres, but the functions that they serve here are not like the community centres we have in Singapore. They are really here to help people look for jobs, but also as a form of social welfare conduit. If someone has lost their job, they actually can walk to a job centre and get some financial assistance to help them before they look for their next job. Hang on, I think it's a screen okay?
I think somebody commented I'm not in swap screen already.
Yeah.
1 second, thanks.
Thanks for letting us know that the screen is not showing in the presentation mode. We will do the swap of the screen to the presentation mode for the audience.
Okay.
Okay, so we need to go to presentation mode.
Is it in presentation mode now?
No, we are. Okay, from here you need to go to the display setting to swap the screen. Correct. Yep.
Correct? No.
Yes, perfect. Thank you very much.
Great.
Thank you.
This way. Yeah, so sorry for that. I was explaining what the job center is. So it is one really used to administer the social welfare program in the UK. So in the UK, if somebody typically serving the blue collar workers, if they've lost a job, they can go to a job center, look for some help in not only securing their next job, also in sort of getting some sort of financial assistance to tide them along the way until they look for their new role. Now, the reason why they're sort of really scattered around the UK is because these job centers actually need to be close to population centers, and the government actually has a policy that job centers needs to be within 20 minutes of travel from bus or on the bus or on train for basically anyone that's living in the UK. And I think that's a fairly unique asset that we have. We also do have other assets that leads to other government tenants and DWP, but the DWP is our largest tenant as well. So moving on to our sort of strategy. Around the middle of last year, we sort of went to market to say that we would like to expand our strategy to include not just the current job centers and government workspaces that we have, but also potentially move into student accommodation and build-to-rent residential. Currently, we don't have any in that space, but we do have a pipeline, and we will be talking a bit more. Jonathan will be talking a bit more about the stages of some of these assets, in the pipeline. But why does government and living make sense? Well, firstly, I think we took a step back. Many of the investors that have invested in Elite at IPO, they really sort of like the cash flow that's secured by the UK government leases. It is dependable. It is sovereign in nature, and very importantly, it's counter-cyclical and also non-discretionary. What it means is that whether there's pandemic, whether it's good time or recessions, these assets will continue to be spent on and to be used. And then I think the other bit to think about is also the living sector is actually very well supported and has quite a fair bit of tailwind, strong demand fundamentals, and structural undersupply. Now, if you look at the location of assets, whether you are in student accommodation or build-to-rent residential, you want to be in the city center, you want to be close to transportation hubs. And that's exactly what our current portfolio of job centers and government workspaces look like in terms of the location. At the end of the day, whether we can reposition existing asset into a student accommodation or build-to-rent residential, we'll need to meet certain filters. Firstly, it needs to be viable. We wouldn't be building a student accommodation in a town without a university, for example. That's quite fundamental. Of course, strategy needs to be right. So our strategy is living and government. If someone comes along and say, would you do a logistics, for example, then that's a bit left field for us. So it needs to align with our strategy. Scale opportunity is also very important. We wouldn't want to do a small deal it should be of a sufficient size, both in terms of in terms of operational economics, that it works better. And also, last but not least, risk and returns. It needs to make sense financially for us and for our unit holders. And I mentioned that so I think maybe the next section I could let Michael, our CFO, take us through some of the high points of our most recent financial performance.
Yep. Thank you, Josh. Hi everyone. Hope everyone have a good evening. Let me bring you through the financial performance of the REIT year on year. So from a revenue perspective, it's rather stable. It didn't change materially. This is also on the back of the acquisition that we have done back in June, where we acquired 3 assets. And then moving on, distributable income and the adjusted DPU increased by 6% year on year on average. This is on the back of the interest savings that we have accumulated, as well as the tax benefits that arise from our sustainability capex that we have incurred on our property. So moving along to capital management, I think this is where we want to showcase the loan tenor of our portfolio. So our portfolio makes up of 2 loans. These 2 loan tranches are due in 2027 with a 2-year extension option to 2029. This means that from now all the way to essentially 27-29, we do not have any risk of this loan getting matured and need to be repaid. I think the other thing that investors like yourself will take note of is the net gearing ratio. So net gearing ratio as at 30th September vis-a-vis 31st December is flat at 42.5. But this didn't tell the whole story. So the story here is that September and March typically is our distribution quarters and half years. So normally we have an undrawn revolving credit facility there. What we do is we collect our rental 3 months in advance from our tenant, and then we use this cash to pay down our RCF or revolving credit facility. Then come distribution quarters, we'll draw back up and distribute. So this allows us to further enhance and save borrowing costs during the lull period. And 31st December is allowed. 30th September is where we distributed. So I think one can see what's the trending like reaching to 31st December 2025. All our loans are in GBP, our units are in GBP, our revenues are in GBP, so it's all naturally hedged, no FX concern here. And then I think last but not least, just want to point out that all our loans are sustainability linked, means whenever we hit certain hurdles, there's a little bit of cost savings that comes back to the REIT as well as flow it through to the unit holder like yourself. Moving on to the next slide is how does the REIT manage our interest rate risk. So I think this is something that definitely retail investors like yourself will take a closer eye on, because interest rate basically is the cost that the REIT has to pay. So last year, on the back of the refinancing of our loan, we also undertake and put in place an interest rate swap. So if you look at the chart on the right hand side, the rectangle blue bar indicates the time period where we actually put in place the interest rate swap. So that's where there's a little bit of a good headwind, good tailwind in the hedges that we put in place. So we capitalize on that, and we actually go into fixed rates, interest rate swaps that allow us to enjoy a favorable rate of 3.8%. So our average borrowing cost is at 4.8% from the highs. Last year, the SONIA was at about 5.25. Now it's about 4. Then 85% of these rates are being hedged. So any fluctuation in the interest rate, we have a buffer against those fluctuations. And last but not least, our interest rate coverage ratio is about 2.7 times, which is rather healthy for the REIT. So I think that's pretty much a good sum, and I'll pass that time back to Josh.
Yeah, so before I hand over to Jonathan to talk about the student accommodation assets, maybe talk a bit broadly about how we think about value creation within our existing portfolio. So our portfolio, repositioning with our student accommodation asset is really kind of the same story. When we right now we're going through at least 3 years with the DWP, and that's progressing quite well. We do estimate that we'll complete this exercise for a substantial tranche this year, incoming first quarter 2026. And that is the number one, strategy that we need to pursue. Now, some assets will then from this lease figure come out to us as vacant, and then we can actually look at how we could, employ some of these strategies to convert it into alternative uses. Most likely student accommodation, but also built to rent residential. And then there are some assets, some very special ones, where there are other sort of other uses that, although they are not within strategy, still very well worth doing, because I think it increases valuation for the assets. And then we could spend just a bit of money to convert them within our means. And once they're ready, we could actually monetize them, and that would the monetized profits could be used to come back into the entire capital structure. So, for example, what I'm talking here about is Peel Park. Peel Park is one of the assets in Blackpool in the northwest of the UK. About a third of it is occupied by the Department of Work and Pensions, our largest tenant. The other 2/3 of it is actually overflow car parking plus grassland. So we went to the authorities to try to convert that 2/3 that's underutilized to be converted into a data center. It is quite conducive because over there they have abundance of power, and also there is a new data cable that has landed in Blackpool. Very recently, I think that in the last few months we've gotten altogether 120 MVA of power. So that has helped us to get to this journey. And we're currently awaiting the planner's approval to take it into the data center space. So once we get planning, we already have power. The next step is to try to monetize this asset. And then I think a few months ago we've announced that we have the planning on Lindsay House. And that is, an asset that we're taking towards conversion and development. But also in this quarter, we have added one more asset to the portfolio, and that's Cambria House in Cardiff. Its location is really good next to the university, and we have very recently obtained a positive pre-planning outcome with the City Council of Cardiff. John, I'll let you talk about the two assets in the markets.
Yeah, thanks a lot, Josh. So just flicking through to the next slide. Josh has provided some explanation about why it's the case that when government leave an office building, we'll look to find out if there is a reasonable route to securing a value accretion outcome based on the specifics of each individual asset. So to date, we've out of our portfolio of 150 or so properties that the REIT has owned, this is the first property which we have selected for a development. And you can see quite clearly from this map that the fundamentals of this property are ideally suited to a development for student housing. So Dundee is a city on the east coast of Scotland, very close to St Andrews. St Andrews is the voted the best university in the UK, but Dundee has a strong academic, a number of strong academic institutions, including Dundee University and University of Abertay. So with these two universities, there's 16,000 students in Dundee. I'm just going to flick back to the previous page, actually, just to talk about the fundamentals of the property, which are almost always based in real estate terms on location. So the building is situated directly in between those two major universities, and also extremely close to the city centre, to the retail amenity in Dundee itself. It's walking distance to the train station. so students who would stay at this facility would have immediate access to both universities as well as to the retail amenity. So what we're dealing with here is an office building which we've received a planning zoning consent to convert provide 168 studio bedrooms, and that the construction will be completed to allow operations to commence in 2027. So this is a good start for the REIT because this is a conversion. We're not dealing with any ground up development. The building is well configured to be converted into a student housing facility with actually minimal, if no, structural work required to change the building whatsoever. So it's a relatively low risk, or it's a lower risk development, and therefore probably appropriate for the REIT to start off with as a development project. On the next slide, there are some market stats about the Dundee market, which I think go to explain how careful we are when we assess every opportunity in terms of its potential for to be redeveloped into an alternative use. And so we're looking closely at the market dynamics. I've spoken about the number of students that go to these two universities in Dundee, 16,000. And Dundee itself only provides, or has today, less than 5,000 PBSA beds across 17 schemes. And the majority of those schemes are more than 10 years, if not 20 years old. So there's a very limited supply of good quality student housing in Dundee. Dundee is the two universities are popular both with domestic and international students, and a 3.5 times student to bed ratio represents a very significant level of undersupply, and this has led to existing facilities in Dundee consistently reporting more than 95% occupancy. So overall, this presents a really good opportunity to deliver a high quality PBSA facility with a moderate risk profile, and with the potential to generate a yield on cost which is significantly ahead of where yields are for income producing PBSA in Dundee. As we note here, yields can be between 5 and 7% for income producing stock, and we would expect the development project to yield a better outcome than that, therefore generating a value accretion for the REIT. So that's the first project which is under construction. The strip out is going on as we speak. The next project Josh has mentioned slightly, which is Cambria House in Cardiff. Again, we're seeing the importance of location, and you need to be as close as possible to the universities, as close as possible to the retail amenity. That's really what's going to make the core derived demand from the core student population, which is made up of not only domestic students, particularly domestic students in their first year of university, but also international students. And Cardiff University is a Russell Group university, which means it's in the top rank of UK universities. We're looking at securing a planning consent for a development of 348 student beds. Cardiff is the capital city of Wales. It also has several academic institutions, and as we can see on this slide, there are more than 45,000 students that are attending major universities in Cardiff at present. This gives an enormous student housing to bed ratio of 6.5 times. That's for the premium segment of the market. Cardiff, a bit like Dundee, has some existing PBSA stock, but a lot of that stock is first generation, so more than 10 years old, and so there is a very significant demand for good quality student housing in Cardiff, with the market reporting occupancy levels upwards of 95%, and also compound average growth rates of more than 1% every year over the past 10 years. So a consistently growing student population. There are a few more stats on the following page, which just talk to the situation, the proximity to the universities, proximity to public transportation, and the number of students, the level of supply constraint. So this is a rigorous analysis that we're going through with every single one of our properties, but we're also very much focused on risk management. So only going to be taking forward a development which is suitable for the REIT's strategy, which is to diversify away from being a pure commercial REIT into the living sector. So yeah, that's it on the two PBSA opportunities we're most focused on at present.
Yeah, thanks, Jonathan. I think if I could quickly summarize some of the key priorities of the REIT for the rest of 2026, and then we can move on to Q&A. So number one, I think very front and center on our minds, and something that Jonathan and ourselves have been very busy with, is the lease regear. So we want to complete a partial part of our lease regear early. This is our leases that actually mature in 2028. We want to do this by the first quarter 2026. Evidently, we feel rather confident on timeline to be putting this date on paper and telling our unit holders that we expect this to be done very soon. And then I think the other bit is also, we're quite focused for next year to continue to grow. And how we do that is to divest assets sometimes and to reinvest them into creative opportunities. Repositioning asset, that's really ongoing. Lindsay House, Cambria House, Pure Park, and perhaps more as well. As we go through the lease regear, we then would know which sort of assets we can then take them into development. And then because we would have done a substantial part of the lease regear for next year, it also builds up the momentum for us to try to lower our cost of debt and also broaden our sources of debt through potentially working with other lenders or other debt sources for next year. So we want to optimize our capital structure and continue to do well there. Last but not least, this year was quite an important year where we have almost double our trading liquidity. We can still do better. Currently, we have 7 analysts covering us, all with a buy call, and we hope to take that up to more analyst coverage next year as well. And because the liquidity has improved, we are right now on track to be included in some minor indices for 2026 as well. Maybe back to you, Sunny, for Q&A.
All right. Thank you, Joshua, Jonathan, and Michael, for your very detailed and informative sharing earlier. Do stay with us on the line. We will now move on to the Q&A segment. So for our audience here, please submit your question in the Q&A chat. And if you are on YouTube, you can join us via the Zoom link so that you can post your question as well. And for audience on our Tiger platform, you can post your question there. And I try to answer I try to post as many of your questions to our senior management here today. Okay. So we endeavor to answer as many questions as possible. Let's proceed to the Q&A session now. Maybe let me start with the 3 pre-submitted questions. The first question coming in, pre-submitted ones, was asking, will Elite UK REIT be thinking of diversifying the REIT in terms of going into other segments like retail, commercial, or even data centers, or even other countries, other geographical regions?
So let me answer that. Other countries know we are focused on the UK, and that's not a bad idea as well, because I think we need to have this sort of strategic focus in one market. It also gets us the natural hedge that we have in our capital structure. But also, I think the UK itself is a very, very deep and significant real estate market. So just looking at real estate and in the UK, I think there is really a lot of things to do. Then in terms of sector-wise, currently we're focused on government assets. And whilst we're the only one that's listed on SGX, there are actually peers that are listed on LSE. Many of them actually holding assets that also derive the cash flows from the UK government. For example, there are REITs that hold assets that's hospitals that's leased to the UK National Healthcare Scheme, and also offices leased to the tax department, offices leased to the Ministry of Defense, and so on. So that is a very thriving and deep sector as well. It's not a niche sector outside of the UK. So I think that's really some of it. I think there is quite a lot of things to do. Just focus on the sectors that we're focused on, focus on the geography that we're focused on.
Thanks, Mr. Joshua, for that clarification. So we are still focusing on UK as of now. The next question coming in pre-submitted is asking about what could be possible pipeline that could be coming from a sponsor that would add diversity to the current portfolio of government and student housing.
So student housing, nothing. And the reason why it's nothing as well, even if there is a portfolio, is because it's not going to yield accretive. Currently, I think PBSA in the market will yield between 5 to 7%. Our current cost of equity, and that's a dividend yield that our unit holders are receiving. That's about 8.5, 8.6%. Even if we blend that with debt, it would not make it yield accretive at first. So the best way for us to deliver PBSA product into this portfolio is really to develop them from within our existing portfolio. But the sponsors do have a sort of a private fund that holds other government assets, and that's quite interesting. But I think without talking too much about these assets, maybe if I could focus on what we think would be assets that we would want to buy, be it sponsors or external. Firstly, as I mentioned, it needs to be yield accretive. Secondly, it needs to be within our strategy. So either student or government, but student, we're going to cross it out for the time being. And of course, these assets tend to be long WALE as well. Last but not least, it needs to be from a risk-adjusted basis. It needs to make sense. Because frankly, Sunny, there are assets in the UK where it can do a yield at 30% as well. But these are the dangerous assets. If it's too good to be true, there's usually a reason why.
Understand that. So I think a lot of our unit holders are also very appreciative of the stable yield that you guys are paying out. So that's why we need to look at the assets carefully before thinking about any acquisitions going forward. Okay, let me move to the last pre-submitted question before I move on to the Q&A, which I see the questions are coming in very fast. So the last pre-submitted question is asking, just now you talked about improving trading liquidity. So are there other initiatives that you guys will be doing, an investor roadshow or something like that, to ensure that there is sufficient liquidity to improve trading going forward?
Yeah, absolutely. I just came back from Dubai this morning. I've only slept 4 hours. So these are trips and these are engagements that are very valuable for us. And that's why, we're staying up to have this sort of engagements. When I took over as a CEO about 3 years ago, we had at one point only 3 brokers covering us. Today we're 7. And there is no such thing as having too much coverage. We want to have more voices so investors can understand us. And we do have that direct contact with unit holders, both on LinkedIn as well as if you went to our website, you could also sign up for email alerts, like email directly coming from myself or investor relations. So we do want to improve the awareness and the equity coverage. Then I think we also do work with some liquidity provider to provide that access to the liquidity to help. But ultimately, we do need to have news flow. We do need to have the right projects to catalyze the asset. And I think this year has been quite a good year for that.
Okay, thanks for that answer. I think we do look forward to you getting on this show as and when you have new business update that you can share with the unit holders as well. Okay, let us now move to the live Q&A section. I can see the first question coming in from Mr. Leong. He is saying that he assumed Elite UK REIT is borrowing in the GBP, the pound. Is there any case to borrow in Swiss franc that can help to lower the interest rates for Elite UK REIT?
Yeah,
Yeah.
CFO.
Yeah, I will take that. Truth to be told, I have not explored borrowing in Swiss franc. I think in one of the slides that I earlier shared, we are naturally hedged all our expenditures, our income, our loan, our units, our distribution are all in GBP. I will take that point into consideration. I will do a bit of homework on the pros and cons of borrowing in Swiss franc. But as far as I'm concerned, we'll try to keep it all naturally hedged as much as possible.
Okay, but that if let's say we were to borrow in Swiss franc, that would introduce certain FX management that we need to take care of as well, right?
Yes, definitely.
Okay, so I hope that will answer Mr. Leong's question. The next question that we have is about this new regulation called a mention tax by the UK government. So does Elite UK REIT view this regulatory risk, and what are the mitigation or hedging strategies that you guys will be adopting to protect the unit holders' dividends as well as capital returns?
Yeah, so I mean, I think it all together, I think I saw some other questions on the the UK budget that was really fresh off the press, hot off the press rather this time yesterday. And that's one reason why I haven't slept much, because I think we've been very quickly trying to update our board, trying to update our investors on how that could affect us or what's the implication. So bear in mind, it might be a very long answer. This morning as well, we sent out the email update. So again, go to our website and sign up for our email alerts, so you can be informed on such sort of things as well. So I think we've been watching this autumn budget very closely. Some initial market reactions is that the gilts actually eased 14 basis points to 4.42%. The FTSE 100 and 250 was also roughly up about 1%. And other REITs in the UK also traded up about 2%, and that really outperforms the FTSE 100 and 250. So basically, these moves, although they are quite modest, there is no market meltdown, and the market has really absorbed some of this budget without concerns. They weren't very excited, but they weren't overly disappointed as well. Now, there was a lot of things announced in the budget yesterday, but if I could maybe filter like 3 or 4 things that really are most relevant to Elite UK REIT. Number one is that I think you can tell that the government is leading some structural tax measures. They're freezing tax income thresholds. They're doing like higher taxes on investment income and property-related wealth, which is the mentioned tax. But all of these actually doesn't affect us. In fact, we do have a UK REIT regime. So this actually what it means is that we qualify as a tax entity in the UK where our tax is no worse than a LSE listed REIT. So what it means is that our distributions will remain competitive and unaffected even with this budget. So the rate that we pay as a landlord in the UK will be far lower than other commercial landlords. There are other REITs, for example, in Singapore as well, that own assets in the UK. They will pay a far higher level of tax. Then I think the other thing is also you see that the fiscal posture with this budget, especially with the buffer, that the much larger buffer will support a more stable gilt environment. And that's really helpful for valuations and capital management as well. Last but not least, on the asset perspective, with a focus on welfare, universal credit, youth and employment outcomes, this is all in line with the Labour Party's manifestos. Now, of course, the job centres are the key delivery sort of conduit for some of these policies. Maybe I'll pause a little bit to see, John, if you want to jump in to talk about some of what you think from the ground.
No, I was just going to quickly answer on the mansion tax point, which is only on housing for high value kind of residential properties where people are paying individual council tax. So it's not going to be a situation that affects the majority of our portfolio or even the PBSA assets, because these are held for rent, so not considered as a single property in that sense. So the mansion tax is not going to be affecting the REIT. I mean, I think, yeah, just from the ground, the overall assessment is that the UK fiscal position is actually a lot better than many people had thought it was going to be, and a lot better than the impression that the government had given about what it was going to be like. So I think there had been a reasonable amount of concern about how much taxes and the way government would try and raise the amount of tax that they said that they were going to need to. And it appears from the budget, although they've raised taxes, they haven't had to perhaps raise them by as much as everybody feared. But the key point I think Josh has already mentioned, which is actually quite a stable outlook following this budget, which is the first time for a while that actually a chancellor has given a budget in the UK which has generated some stability. So I think we're supportive of that, even if not paying more tax personally, which is something that people in the UK are going to have to deal with.
I think if I could draw some possible implications for us with regards to interest rate as well, if I can take that a bit further. I think even before this budget was announced yesterday, the markets was pricing in a 87% probability of a rate cut in December and 2 more rate cuts in next year. Now with this budget being announced, it's almost a 100% certainty that the December rate cut will come down. And next year, I think most people are pointing to a 3.25% or 3.5% bank rate. So all quite positive. Now, what does that mean? A couple of things. One, the base rate will actually open the door for Michael to do a refinancing potentially. And that's also one of the things, one of the key sort of initiatives we have in 2026. Of course, the very lower borrowing cost of DPO will go up. The other bit is also we are now in valuation season for most REITs with the 31st December year end. And this lower gilt environment will actually support a cap rate stability, and that will also help with our upcoming valuations at year end. Last but not least, I think usually REITs yield are priced as a premium over the gilts. Now, if the gilts are coming down, your risk rate is coming down, then what you see is that our current yield right now is actually very attractive 400 basis points over the 10-year risk-free rates in the UK. So I think that's some of the key points from our perspective.
Well, thanks for that latest update on this latest development on the UK side of things. I think our audience will be very appreciative that you are sharing this perspective with us despite the news just coming out yesterday. So you heard it first here on the SIAS Corporate Connect webinar as well as the Tiger Broker platform. So we do have a few more minutes left. Let us go through the last few questions. Next question is, are there any steps that the business, the REIT is taking to ensure that there's a sustainability initiative that can help to protect long-term profits and support the dividends going forward?
I'm connected. John? Oh, I think it's us.
Sorry, say that again. Was that one for me? Hello?
Yes, I think, John, if you have, you can add in a few words first. We are having some connection issues with the Singapore side.
All right, okay. Sorry. Could you just quickly remind me of the question which we were going to answer here?
Yeah, let me just repeat the questions. Are there any sustainability efforts that can help protect the long-term profits and support the dividends going forward for Elite UK REITs?
Yeah, I mean, one of the things which we did a couple of years ago is when we were doing a re-gearing exercise for the leases with DWP, we took out about 92% of lease breaks across the portfolio, and in return we provided the DWP with some capital which needed to be spent on improving the energy performance of the assets. So essentially capital investment in the properties geared to improving the sustainability of the assets. It was quite an innovative approach to dealing with a tenant and providing them with a capital sum which needed to be spent actually on the buildings. So that was about a £15 million investment that the REIT made. That was then added to by DWP. DWP themselves spent about £45 million on top of the £15 million which the REIT provided. So there was a very significant sum that was spent on our portfolio, funded by landlord Elite and tenant DWP, focused on improving the sustainability credentials of the properties. Ultimately, any improvement to property by a tenant is an indicator that they have an intention to remain in that property over a long term. And so, and by long term, we mean to sign new leases. If the tenant's signing new leases, then the income profile for the REIT is protected. That's that's how we've gone about achieving that. And we hope to carry on having that kind of relationship with our tenant where we see them investing in our properties and they're happy to sign new longer term leases.
Thanks, John, for that answers for this question. Anything else to add on the Singapore side management team?
No, I think John deals with these as they are.
All right, noted. Yes, the time is 8 p.m. Thanks for staying back with us. We'll do the quick fire questions for the last two questions, I think. Any plans to raise funds from existing shareholders through rights issuance?
So I think with any fundraising that needs to be raised, it needs to be done for the right reason. And the way we do it generally has been so far since I've been here, either placement or a preferential offering, which is a form of rights issue. Except that usually for preferential offering, your discount is limited at a maximum of 10%. That's regulatory cap nature. So I think when we did the fundraising back in start of 2024, we did it by preferential offering. The fundraising we did in June this year is a small one. It's a placement. So I think both styles of fundraising can achieve different objectives. So I think we will be open to both. But I think more importantly, beyond the style of fundraising is why you're doing the fundraising. So it needs to be for a creative acquisition, for example, to buy the right things. I think where I think right now our gearing, for example, is a very, very comfortable position as well.
Okay, and I think we have the next questions on the payout ratio. Is Elite UK REIT planning to adjust its payout ratio in response to current market uncertainty due to interest rates, or is the management committed to keeping the payout at historical levels?
Yeah, so actually we're quite comfortable where we are right now. I think some of the unit holders might remember in the early part of 2023, I believe, we had then taken down our payout ratio from 100%, which was at IPO, to 90%, which was a bit more in anticipation of some of the uncertainty in the market. For example, at the point in time, we had lease breaks that were not sort of resolved at the point in time. We had valuation coming down, and we also had a loan refinancing that needs to be done. So along the way, we checked them off systematically. Valuations have stabilized. Loans has been refinanced. We have no refinancing till 2027, and as I've shared, we plan to try to early refinance next year some of our loans if we can. And also, I think some of the headwinds with capital structure gearing that has also gone away as a result of some of these things we've done. So I think we're quite in a comfortable position, but I think the world seems to be a bit more volatile. So I think we probably stay where we are. Probably won't settle up to 100%. But I think when we stepped back from 90% to 95% last year, we took that decision when we really had that introspect, because taking it back downwards from 95 back to 90% is not going to be great news, and it's not something that we want to live through again. So I think we took a lot of thought in making that decision. We're comfortable where we are.
Right, I think that gives investors or unit holders a lot of assurance that the management is committed to keeping the payout at this current level. And I'd like to thank Elite UK REIT management team for staying back with us despite past 8 p.m. We're at 8:05 now. I believe this is all the time that we have. I'd like to thank Joshua, I'd like to thank Jonathan, and I'd like to thank Michael again for coming to this show today. We have come to the end of this week's Corporate Connect session, and we hope that all our viewers enjoyed this session. In case you miss any part of today's session, you can actually rewatch this webinar on the SIAS YouTube channel, okay? So do visit us on our website to get the latest updates on the latest investor education program as well as initiative. And our next Corporate Connect session will be on next Tuesday. So in the meantime, I hope everyone will trade safe and stay safe and have a very good evening ahead, okay? Thank you, everyone, and have a good evening. Goodbye.
Thanks,
Thank you.
Thanks, James.
Thank you, everyone. Good night.
Thank you, everyone.
Bye. Thanks, everyone.
Thank you.